Hi, I'm Thomas. Welcome to the course Corporate Finance. Today's lecture is Equity Capital. We can divide equity capital into two general categories. One is private equity, which comes from individual investors who aren't anticipating in the short term participating in a current market, i.e. they're investing as owners without planning to sell their shares into the public markets. And public equity, which is raised through initially an initial public offering through which a company receives proceeds from an equity sale to the public. And the public equity markets also have a secondary offering component, which allows for companies to raise additional capital again in the public markets in the future through additional offerings as they seek more equity capital. Common sources of private equity are angel investors, who are usually the first early stage investors to invest beyond the management group or the founders of a company. Then venture capital investors, who are looking to be early stage investors, probably not the very first investor, but they're looking at early stage companies that are probably high risk, not necessarily profitable yet. So these investors are looking for high risk, high return investment opportunities. Later, institutional investors who want to get involved at a later stage, usually once there's a proven business model that's generating revenue and net income. And finally, corporate investors who aren't necessarily focused from the entity standpoint on investing in companies as their main business model, but they might be looking for investment opportunities and could have large amounts of capital available for equity investment. Let's look at funding concepts relating to private equity. One common structure of private equity is convertible preferred stock. Preferred stock gives the investors a priority position over common shareholders. This might be structured with the outside investor holding preferred stock, which will have priority over the common stock of the founders of the company. The common stockholder has the option to convert from preferred to common, which is the decision the investor would make if they see that the company is growing and the common stock has the potential to increase significantly in value. Anytime a company experiences significant growth that results in a value increase, that value increase is going to the common stock. And so a preferred shareholder would be incentivized in a high growth situation to convert to common to be able to participate in the company value increase. But before conversion, the preferred stockholders, they have seniority to the common stockholders, and so that would give them the priority in the situation in which cash flows are less than expected, the priority to receive payment from company proceeds before common shareholders. Another important funding concept relates to pre-money and post-money valuation, and we'll see an example of these calculations in a moment. And then finally, the way to exit a private investment is for a company to go public through an IPO, an initial public offering. Most equity investors ultimately want an exit opportunity. They have some kind of an exit strategy. When a company is private, the ability to sell or liquidate your investment is limited. But when a company is public and a company goes public through an IPO, then there's a public market and liquidity, a much better opportunity for an investor to exit through selling their shares to another party. Now let's look at the concept of valuation through pre-money valuation and post-money valuation. In this situation, you are the entrepreneur and you start a company with $100,000. You're the only investor. That means you own the entire company, and you've designated the share base as 1.5 million shares. A new investor comes in later for 500,000 shares, which means the total share base goes up, and their investment for that 500,000 shares is $500,000. And then at third stage of investment, a venture capitalist comes in investing $6 million. The venture capitalist receives 3 million shares. So now the share base has gone up significantly, as has the total capital invested. So the questions are, what is the pre-money valuation? And we have two pre-money situations, one before the angel investor and then another before the venture capitalist. And these also relate to post-money, the post-money valuation after the angel investor and after the venture capitalist. And finally, after these two outside investors come in, what is the valuation and percentage ownership of your shares as the original investor, the founding investor with 1.5 million shares? And the key to understanding pre- and post-money valuation is that the percentage ownership is based on the number of shares, and that is only changing as new shareholders come in. The price per share is driven by the last investor to come in, and so whatever any prior investment per share price calculation was will change to the most recent per share valuation as new investors come in. So looking at our example, the founder invested at a per share value of 7 cents per share, which we see as the first row in our analysis. When the angel investor came in, based on the dollar amount that they invested and the number of shares they received, they were investing at $1 per share, which means that every investor, in particular the original investor, the founder, now has an investment that's been valued at $1 per share. When we see the venture capitalist invest, they're investing $6 million for $3 million per share at $2 per share, and so everybody's shares are now valued at $2 per share. As the second and third layers of investors come in, the founder's shares, the founder percentage of ownership, is diluted from 100% to lower and lower percentages. Looking at the summary valuation and percentage ownership at the bottom of the screen, the founder now has 30% of the company, based on owning 1.5 million shares out of a total share base of 5 million shares. And the valuation for the founder, each of those 1.5 million shares is worth $2 per share, based on the most recent investor, the venture capital investor, based on their investment valuation, and therefore the founder's share value in total is $3 million. Notice that is a significant increase from the initial $100,000 investment. That is driven by the higher per share value that has resulted from the increasingly favorable valuations, first of the angel investor and then of the venture capitalist. The company is private. There isn't really any market for the founder to sell these shares into, so the $3 million valuation is simply on paper. It's not an actual liquid asset that can be sold into a market quickly. Now, to do that, to create a liquid market, a company goes public. This is the initial public offering. When a company goes public, they're going to offer new shares to the public to bring in more money, more capital, to expand, to make new investments, etc. That creates more accountability. When a company opens up its investment opportunity to the public, the government is going to be involved. There are market regulators that are government entities. In the U.S., this is the Securities and Exchange Commission. In addition, the public company is required in most countries to prepare and provide audited financial statements so that the public has assurance that the financial reporting of the company is legitimate, is accurate, and is based on financial reporting standards such as GAAP in the United States or IFRS in an international setting. Underwriters get involved in the initial public offering. They're involved in valuing the company, determining how much the company is worth in total, and then determining what the per share value is of that company, as well as marketing, presenting the investment opportunity to institutional investors who are investors that invest large sums of money. And the idea of the underwriters is to get these big investors to put in money and raise the requested capital of the company that is going public. The first step is to get a commitment from these institutional investors who make the commitment to invest in the company. They're going to buy the shares at the set valuation per share price of the underwriter. And then once the company is listed on the public exchange, they'll be able to resell their shares into the secondary market. Once the company sells shares to the initial buyers, typically institutional investors, the company will receive their funds, and then the institutional investors, should they choose to sell their shares into the market, they receive funds in the secondary market transaction. But any secondary market transaction doesn't at all affect the cash balance of the issuing company. It does have the effect in changing the share price, and as the share price of the issuing company goes up, they have a more favorable image in the market, but they don't benefit directly by receiving more cash unless they do a secondary offering. If they sell more shares in the future, then they will benefit from an increase in share price. How is money made in these transactions? From the underwriter's perspective, they earn money through the spread. The spread is what they pay to buy the shares from the issuer compared to the price at which they sell the shares to the institutional investors. So an underwriter might agree to buy shares from a company going public at $9.85 per share, and then immediately sell those shares to institutional investors at $10 per share, and they're earning that 15 cents per share profit. Once the institutional investors sell their shares, anything they sell beyond $10 per share is profit. As an investor, the underwriter and the company are not involved. Now, where does the valuation come from? Let's look at an example of how a company is valued for an initial public offering. Here we have a company, Wagner. They have pro forma revenues and pro forma earnings. Pro forma means after the money comes in from the offering, what will the new company's performance look like? They're going to raise some money. With that money, they can make new investment. With those new investments, they anticipate an increase in revenue, an increase in earnings. So what is the company going to look like on a pro forma basis after they invest and see a result in the IPO proceeds? This company will have $325 million in revenues and $15 million in earnings. They currently have 2 million shares outstanding, and they're going to sell 18 million shares in the IPO. So they'll have 20 million total shares outstanding. Now, what do these numbers all mean? Well, we want to look at how other companies that are already public are valued in the markets, and we'll use those metrics to estimate the value for this company, Wagner. Other companies are valued at 0.9 times revenues. That means that if you multiply their annual revenues times 0.9, that's the typical valuation of a company like Wagner, or 21 times earnings. So if you take a company like Wagner, look at their earnings, their net income, multiply that number by 21, that's the typical value of the companies similar to Wagner trading in the public markets. So we want to know the IPO price range, and then the post-IPO, after the new shares are issued, combined with the existing shares, what's the range of value of Wagner Incorporated? And in this evaluation, we're doing two valuations that won't give us the same value. Thus, we have the range. When we take the results of Wagner, the revenues and the earnings, we use a multiple of revenues and a multiple of earnings. We get two different valuations for the company, both around $300 million, but again, we have a range. That's the total range. We want to get to a per share valuation. So the number of shares outstanding is the 2 million outstanding prior to the IPO plus the 18 million shares issued in the IPO. That gives us a total share base of 20 million. And when we divide the two valuation numbers based on revenues and earnings by the 20 million shares outstanding, we now have a per share valuation range of $14.63 on the low end to $15.75 on the high end. So the underwriter will probably propose to the company that we go public at a price in this range. The company will prefer to go public at as high of a price possible to generate more cash coming into the company. The underwriter will perhaps want to be somewhere in the middle or maybe closer to the low end to ensure a successful offering. And the underwriter ultimately is working for the client, so the underwriter will advise the client, in this case Wagner, but ultimately will need to agree to the price that Wagner requests to set the IPO at the price per share. Let's look at the Google IPO. Google actually used an auction IPO, which is a slightly different process of valuing the company and offering shares. In an auction IPO, the bankers for the company, in this case Google, take requests from various investors that inform the bankers how many shares the investor is willing to buy and what price they are willing to pay. Now, of course, as price goes up, demand goes down, as with any product. So let's look at how the Google auction IPO worked. If we start at the bottom of this chart, we see that at a price of $100, there was a demand for 4,500,000 shares. And as the price went down, additional investors were willing to purchase shares. So at $95 per share, an additional 4.9 million shares demand came in, and the cumulative demand was now 9,400,000. At a slightly lower price, $90 per share, an additional demand of 5,500,000 shares came in. Now the cumulative demand was 14,900, and you can keep working your way up the chart at a lower and lower and lower price. Demand on the cumulative end, the far right column, cumulative demand goes higher and higher and higher. As the price is going down, the total demand goes up. Again, as with any product. Google says we need to sell around 20 million shares. At the $85 per share price, the demand for shares is enough so that if we sell this many shares and the buyers will pay $85 each, then we will raise enough capital, and we don't want to sell at any lower of a price, and we won't benefit if we sell at any higher of a price because we won't receive the total capital that we need from the offering. So in this way, Google set their price. As a result of using the auction IPO, they know beforehand the right price to set. They raise the capital that they need, and typical fees in this structure are lower than a traditional IPO. So Google was able to save some money in using this process as well. This is not the typical process, but in the case of Google, this is how they did it, and they were able to get information based on supply and demand to issue the right number of shares at the highest price possible while obtaining the sufficient capital that they were requesting to be able to fulfill their plans for the company. And finally, let's talk about, again, the primary market versus the secondary market. We mentioned earlier that the primary market is when a company sells shares to investors. And as a result, the company is receiving the proceeds of the sale. The investors provide the money, and the company receives the funds. The funds come in, and new owners have ownership in the company. So the previous owners of the company, they're still owners, but they have been diluted. They own a smaller percentage of the company. In the case of the secondary market, this is a transaction investor to investor. The issuing company is not involved. In the secondary market, one investor sells and another investor buys. So the money is moving from one investor to another. The company who is the issuer isn't involved. They're not receiving any cash from that transaction. Note that primary and secondary market are different than primary and secondary offering. In the secondary market, the issuer isn't involved. They're not receiving any funds. In a secondary offering, this is when the issuing company goes to the market again to issue new shares to investors through the public markets. And in the secondary offering, the issuing company does receive cash from new investors. However, in the secondary market, the seller is an investor and the buyer is an investor, and the issuing company is not involved. This concludes the lecture Equity Capital. In class, we'll work through examples of these concepts to make sure you understand how to use these ideas, concepts, and tools in a real-world setting, and I look forward to seeing you then.